We are initiating coverage on CloudSec Inc. with an overweight rating and a 12-month price target of $345, representing a 22% upside from current levels. Our thesis is predicated on the company's dominant architectural advantage in the Cloud-Native Application Protection Platform, or CNAPP, market. As enterprise workloads migrate to multi-cloud environments, legacy perimeter defenses are structurally obsolete. CloudSec's consolidated platform approach yields a proven 30% reduction in total cost of ownership for enterprise clients. We project a 35% compound annual growth rate in annual recurring revenue over the next 3 fiscal years, driven by vendor consolidation and strong net revenue retention. Risk-reward is highly asymmetrical here, given the inflection in free cash flow generation expected by fiscal year 2026. The fundamental driver for CloudSec is the rapid expansion of the total addressable market for cloud security, which our proprietary model estimates will reach $65 billion by 2027. This represents a 24% compound annual growth rate from the current $28 billion baseline. The catalyst is a structural shift from siloed point solutions to integrated platforms. Currently, the average Fortune 500 enterprise deploys over 45 disparate security tools, creating critical visibility gaps. CloudSec's agentless architecture directly solves this alert fatigue. We expect the platformization megatrend to disproportionately benefit scale players. Regulatory mandates regarding data localization and zero-trust architecture further provide a rigid structural tailwind, insulating the sector from broader macroeconomic volatility in enterprise software capital expenditures. Analyzing the competitive moat, CloudSec's proprietary graph database architecture provides a structural data advantage that legacy incumbents cannot replicate without entirely rebuilding their core telemetry systems. By ingesting trillions of signals daily across endpoint, identity, and cloud workloads, the platform exhibits classic network effects. More data improves the machine learning efficacy, which reduces false positives, thereby attracting more enterprise volume. Our technical channel checks confirm that CloudSec's mean time to remediate, or MTTR, is 60% faster than the industry average. Furthermore, the switching costs are prohibitively high once integrated into the CI/CD pipeline. This deep technical integration effectively creates a high-margin, sticky revenue base, with annualized churn sitting well below 3% for enterprise cohorts. Turning to the top-line metrics, CloudSec exhibits best-in-class revenue durability. We model a 35% compound annual growth rate in annual recurring revenue, forecasting a scale from $1.5 billion in FY24 to approximately $3.7 billion by FY27. This growth is bifurcated into 2 vectors: new logo acquisition, which is growing at 22% year-over-year, and systematic upsell into the existing base. The introduction of their new Identity Threat Detection module has a 40% attach rate on new enterprise contracts, up from 15% 12 months ago. Crucially, the remaining performance obligations, or RPO, sit at $2.1 billion, with 65% recognized in the next 12 months, providing excellent near-term revenue visibility. CloudSec's unit economics are transitioning from a hyper-growth cash burn phase into a structurally profitable SaaS model. Gross margins have expanded 300 basis points year-over-year to 78%, driven by public cloud optimization and economies of scale in data hosting. More importantly, we are seeing massive operating leverage in sales and marketing. The LTV to CAC ratio has improved to 5.5x, up from 3.8x in the prior fiscal year. We project non-GAAP operating margins to inflect from -2% to +14% by FY26. Free cash flow margins are already trending ahead of consensus, hitting 18% in the recent quarter. This trajectory firmly places CloudSec in the top decile of the Rule of 40 metric for large-cap software. The fundamental engine of CloudSec's valuation is its land and expand motion, evidenced by its elite net revenue retention rate of 124%. Our cohort analysis reveals that customers on board for over 3 years deploy an average of 4.2 modules, compared to 1.8 modules at initial signing. This modular expansion drives compounding ACV growth with near zero incremental customer acquisition cost. Furthermore, when analyzing the Fortune 500 cohort specifically, NRR spikes to 132%. The platform's consumption-based pricing elements for data ingestion also provide a natural inflation hedge and organic growth lever. This structural upsell dynamic heavily de-risks our terminal value assumptions, as the company is not overly reliant on aggressive top-of-funnel acquisition to sustain its growth vectors. Valuation remains a focal point for institutional pushback, but we argue the premium is warranted. CloudSec currently trades at 11.5 times next 12 months enterprise value to sales and 42 times EV to free cash flow. While a nominal premium to the broader B2B software index trading at 7x, it trades at a discount to its direct high-growth cybersecurity peers, averaging 13x EV to sales. When adjusting for growth using the Rule of 40 framework, CloudSec's growth-adjusted EV to sales multiple is highly attractive. Assuming our projected 25% FCF CAGR through 2028, the forward EV to FCF multiple rapidly compresses to 22x by year 3. We view this as an optimal entry point before the market fully prices in the margin expansion narrative. In our bull case scenario, we model a price target of $410. This assumes hyperscale cloud providers fail to close the native security feature gap, accelerating third-party vendor consolidation. In this model, CloudSec captures 15% of the total market, up from our 10% base case. Furthermore, if the newly launched AI-driven automated remediation engine achieves widespread adoption, it could command a 20% pricing premium. This would drive gross margins above 82% and accelerate operating leverage, yielding a 30% free cash flow margin by FY27. Under these conditions, the market would likely assign a 15x forward EV sales multiple, resulting in substantial alpha generation for investors, positioning ahead of the earnings cycle. Conversely, our bear case yields a price target of $215. The primary downside risk is aggressive commoditization from hyperscalers like AWS and Microsoft bundling native security tools into enterprise license agreements. If macroeconomic tightening forces chief information security officers to accept good enough native security over best-of-breed platforms, we could see new logo growth decelerate to mid-single digits. In this scenario, NRR dips below 110% as upsell friction increases. Consequently, the EV sales multiple would likely contract to the sector average of 7x as growth slows. While the robust balance sheet with $1.8 billion in net cash provides downside protection, multiple compression remains the dominant risk factor for equity holders. To conclude, our $345 price target is derived from a 10-year discounted cash flow analysis, utilizing a 9.5% weighted average cost of capital and a 3.5% terminal growth rate. This DCF aligns closely with our target 12x EV to NTM sales multiple framework. The risk-reward skew is highly favorable, offering a 3-to-1 upside to downside ratio. As the cloud computing architecture becomes the de facto standard for global commerce, securing that infrastructure is non-discretionary. CloudSec is structurally positioned to capture the lion's share of this secular tailwind through its consolidated platform approach. We advise institutional clients to accumulate shares at current levels, particularly using any macroeconomic-induced volatility as an entry point.